Learn how to spot potential dividend cuts before they erode your passive income and long-term compounding returns. If you're building wealth with dividend stocks, you know how tempting a high yield can be. But sometimes, what looks like a safe, steady paycheck can turn into a financial trap. Today, I'll show you 5 warning signs that a high dividend stock isn't as safe as it looks. By the end, you'll know how to protect your portfolio and your future income from nasty surprises. Before we start, remember, this is not financial advice. Always do your own research before investing. So why does this topic matter? Dividend investing is popular because it promises passive income and steady growth. But when companies slash their dividends, it can damage your returns and confidence. Worse, a dividend cut often means the stock price drops too, multiplying your losses. Learning to spot risky dividend stocks early is key to keeping your income and compounding on track. Let's break down the 5 warning signs you need to watch for, using real-world examples and explaining every term along the way. First up, an unusually high dividend yield. The dividend yield is the annual dividend payment divided by the stock price. For example, if a company pays $2 per share each year and its stock trades at $40, the yield is 5%. At first glance, a high yield looks attractive. Who wouldn't want more income for every dollar invested? But here's the catch. If the yield is much higher than similar companies or the overall market, that's often a sign of trouble. Sometimes the market is pricing in risk. The company's stock price may have dropped sharply, perhaps because investors expect earnings to fall or the business is under pressure. Take the example of a TANT in 2021. For years, a TANT offered a high yield, sometimes over 7%, but the company faced heavy debt and business challenges. Eventually, a TANT announced a dividend cut and the stock price fell. Investors who chased the high yield without looking deeper were left disappointed. So, if you see a yield that's much higher than average, don't just celebrate. Ask why the yield is so high. Is the company's business in decline? Is it taking on too much debt? Sometimes, a high yield is a warning, not a gift. Our second warning sign, a dangerously high payout ratio. The payout ratio measures how much of a company's earnings are paid out as dividends. It's simple. If a company earns $1 per share and pays 80 cents in dividends, the payout ratio is 80%. A sustainable payout ratio varies by industry, but generally, lower is safer. If a company pays out almost all its earnings, there's little room for error. Any drop in profits could force a dividend cut. For example, let's look at General Electric in the late 2010. Yes, GE had a very high payout ratio as its profits fell, but it kept paying the same dividend until it couldn't. The company eventually slashed its dividend, and the stock price suffered. As a rule of thumb, be cautious if you see payout ratios consistently above 70 or 80%, unless you have a very good reason to believe the company's earnings are extremely stable. For most businesses, a lower payout ratio leaves more room to reinvest, grow, and protect your dividend. Our third warning sign is declining or inconsistent earnings. Dividends come from profits. If a company's earnings are shrinking year after year, the dividend is at risk, no matter how strong its history. Let's use a simple example. Imagine a retail company that paid a $1 dividend for years, but its profits dropped from $2 per share to just $1.10. It's now using almost all its profits to pay the dividend, with little left for growth or emergencies. If the trend continues, eventually it won't be able to maintain the payout. You can check a company's earnings history easily. Look for steady growth or at least stable results over several years. Avoid companies with a clear downward trend or wild swings in profits. They're more likely to cut the dividend when times get tough. Fourth, watch out for rising debt or weak cash flow. A company can only pay dividends if it generates enough cash. Profits on paper don't always translate to money in the bank, especially if the business is borrowing heavily or has big capital expenses. For example, in the energy sector, many oil and gas companies have historically paid large dividends even during tough times by taking on debt. But this can't last forever. If a company can't pay its bills or refinance its debt, it may have to cut the dividend. When researching a stock, look for trends in the company's debt levels and cash flow statements. Is it borrowing more each year? Is free cash flow, money left over after expenses and investments, shrinking? These are red flags. The safest dividends are paid from steady, growing cash flow, not borrowed money. The fifth and final warning sign: lack of diversification in the company's business. If a company depends on one product, one customer, or one industry, its dividend is more vulnerable to sudden shocks. Let's take the example of a small mining company that generates all its profits from a single mine. If the price of the metal drops or there's an operational problem, the company's income and its dividend could disappear overnight. Compare that to a diversified consumer goods company with many products and markets. If one part of the business struggles, others may pick up the slack, making the dividend safer. As a dividend investor, you want companies with multiple sources of income, so they can weather storms and keep paying you. Diversification isn't just for your portfolio, it matters inside the companies you invest in too. Let's quickly recap the 5 warning signs. 1. An unusually high dividend yield, often a signal of risk, not reward. 2. A payout ratio that's too high for comfort, leaving little margin for error. 3. Declining or inconsistent earnings, putting future dividends at risk. 4. Rising debt or weak cash flow, showing the company may not afford its payments. 5. Lack of business diversification, making the company vulnerable to shocks. If you see one or more of these signs, dig deeper before you invest. Remember, the best dividend stocks aren't just about high yields today. They're about reliable, growing income for years to come. Let's review a few key terms. Simply, dividend yield is how much money you get each year as a percentage of your investment. Payout ratio tells you what share of profits the company is paying out as dividends. Diversification means not putting all your eggs in one basket, either in your portfolio or within the company's business lines. Protecting your passive income starts with careful stock selection. Don't get fooled by high yields alone. Look for companies with healthy profits, reasonable payout ratios, manageable debt, strong cash flow, and diversified operations. If you found this video helpful, please like, subscribe, and leave a comment below. What dividend stocks are you watching, and what warning signs do you look for? Let's learn together and build stronger portfolios. Thanks for watching, and remember, consistent, safe dividends are the foundation of long-term wealth. Keep investing with care,